Welcome to TipTV Finance, where I'm here with Rajan Dal, who's a market analyst at RANsquawk. How are you today, Rajan?
Not too bad, thanks for having me.
Okay, we're speaking in the run-up to the December Fed interest rate decision. It's clearly a pivotal event to be looking at, but what's the overall picture as far as you're concerned?
I mean, we're looking at the fact that the majority of this move today of a 25 basis point hike is priced in, with the Fed futures funds rate pricing in 94.9% of the fact that we're going to get a 25 basis point hike today. So our view and what we're looking at the moment is if there are any surprises. So we want to see if there are any forward projections, any forward guidance on any future rate path hike, and that's what we're really looking at in terms of euro dollar, dollar index and gold. You know, we're really looking to see if they do give any forward guidance today.
But I mean, this is not really the time for any surprises. I mean, you got Janet Yellen there, chair of the Fed, but in a rather awkward position given the president-elect, which is not the one that perhaps she would have gone for. I mean, this is a bit of a mess, isn't it?
It is a bit of a mess, but if there's any time to return to any kind of normalization, I think this Trump-inspired rally is the time to do so. So obviously we've seen stocks rally, as you've seen and as we've mentioned in the past, but also, you know, the inflation coming at the same time. Hopefully the basis point hike can kind of, it's the only time where we've seen it could go, you know, further than it has done in the past. Previously, they were struggling with inflation when they were, you know, trying to increase rates at the same time. This time, it's a bit of a different story. We've got all the stocks rising. We've got, you know, increased fiscal easing, you know, in infrastructure. So there's support there. But then also, you know, we're actually seeing people looking more comfortable about a rate hike now than they did in the past.
Isn't it the other problem, though, that you know, it's all very well to go for a normalization of interest rates, but the problem is the dollar has risen so sharply and so hard that it makes it actually rather difficult to even signal that there's going to be a normalization.
Of course it does, but I think with the rise in oil at the same time, that has been a big problem with inflation. So the rise in oil at the same time, hopefully that can offset some of the problems with it. I think you're right. I think it's going to be pretty cagey. I don't think they're going to, you know, for example, produce a 50 basis point hike. Don't get me wrong. I don't think that's going to happen today. But this is the most comfortable time to produce a hike than we've seen in the last, I don't know, 18 months or so. So I do believe that this is the time maybe to mention that we could see some more bullish action in the future.
We mentioned inflation, but you know, we spent effectively the last 8 years trying to bring back inflationary growth, let's say.
Yes.
Now we might be near that. It's become something which is a horrific disease. Yes. Can we make our mind up about what we really want?
I think they have to induce inflation somehow. And I think obviously the dollar problem with the emerging markets, that's been there for a while. So the recent rise in the dollar has softened the blow slightly in certain cases, but obviously made the emerging market situation a lot worse. Now, you know, looking at how they would introduce any kind of forward guidance, you know, we were looking just this morning about, you know, future projections of, you know, how many rate hikes people think are going to happen next year, and are significantly lower than they thought previously. So at the moment, most of the analysts are predicting maybe 1 to 2 rate hikes next year. So that's what the statement, in my view, is going to be about today. Whether in the press conference or, you know, in the actual statement itself, we get any kind of inclination that we could get more, like maybe to the 3 to 4 side. I mean, I personally don't think it's going to happen, but if we do, maybe we can see some guidance from there.
And on the European side, I mean, like for the UK, what have we got that you feel is important?
I mean, for the Bank of England, I mean, I don't think anything's going to change, anything's going to happen there. I mean, they need to leave themselves a little bit of room to manoeuvre, because I don't think we've felt the full effects of Brexit. And then obviously we had what happened in Europe with RANsquawk, and then obviously the ECB recently, you know, they signalled that bringing it down to 60 billion, you know, was it a taper? I mean, overall, over the longer period of time, it works out to be more money. But the thing is in the statement itself and in the press conference after, Mario Draghi left himself enough room to say that, yeah, if anything else does happen, we have the tools to act again. I mean, he says this every time, it's nothing new. But in my view, it gives him the opinion, because he's tapered it down on the monthly side, where could he cut it off?
So what's the ideal scenario? That the pound and the euro get a bit stronger, and that offsets the normalization pattern in the US? Is that something which could be the right thing to happen?
I mean, that would help. I mean, that would give everybody, you know, make them a lot more comfortable. So I think in the US that they're hoping that that's going to be the case. Like I said, in terms of Brexit in the UK and what's happened here, we've not felt the full effects of what's happened. I mean, it's gone a lot better than everybody's expected. And yesterday we had the Telegraph article, you know, where they were saying that we might not be able to help but have a soft Brexit rather than a very harsh one. So I do believe that it is going to help the US. So we'll wait to see what happens tonight.
Okay, well, we'll wait on that. In the meantime, Rajan Dal, a market analyst at RANsquawk, thank you very much.
Thank you.